As we briefly touched on earlier in this section, if we have a liquidation of a controlled subsidiary to the parent, there's generally no gain or loss recognized on that. So Section 332A applies to that, and it says no gain or loss shall be recognized on the receipt by a corporation of property distributed in complete liquidation of another corporation. Part B, liquidations to which this section applies. So for purposes of this section, a distribution shall be considered to be in complete liquidation only if 1. The corporation receiving such property was, on the date of the adoption of the plan of liquidation, and has continued to be at all times until receipt of the property, the owner of stock meeting the requirements of Section 1504A2 and either 2 or 3. So in this section, I want to note that the parent has to own at least 80% of the total combined voting power of all classes of stock entitled to vote and 80% of the total value of all classes of stock. The Section 318 attribution rules do not apply, and this has to be the case from the adoption of the plan of liquidation to the completion of the plan of liquidation. All right, and then we look at 2 and 3. 2, the distribution is by such other corporation in complete cancellation or redemption of all its stock, and the transfer of all property occurs within the taxable year. In such case, the adoption by the shareholders of the resolution under which is authorized the distribution of all the assets of such corporation in complete cancellation or redemption of all its stock shall be considered an adoption of a plan of liquidation, even though no time for the completion of the transfer of the property is specified in such resolution. So 2 is what we call a one-shot liquidation. So the whole thing happens within 1 year. Number 3 is different. So number 3 is over a period of years. It says such distribution is one of a series of distributions by such other corporation in complete cancellation or redemption of all its stock in accordance with a plan of liquidation under which the transfer of all property under liquidation is to be completed within 3 years from the close of the tax year during which is made the first of a series of distributions. So in 2, it's a one-shot deal. So we complete this full liquidation in 1 year. That's not always reasonable, so we have 3 here. And 3 allows us to complete the liquidation in 3 tax years, but it must be done within 3 tax years. Section 334B1 provides that the parent corporation's basis for property received in liquidation distribution is carried over from the sub. So this makes sense. If I'm not going to recognize gain or loss, then my basis in the assets I receive from a subsidiary is a carryover basis. So that means the sub's basis in the assets are now my basis in the assets. The tax attributes carry over, so net operating losses, earnings and profits, those such things. The parent's basis in the stock it held in the subsidiary is going to be ignored and then is just going to go away. If the subsidiary's assets have built-in losses, though, the parent is going to take a fair market value basis. If the parent is a U.S. corporation, but the sub is a foreign corporation, and the aggregate adjusted basis of the transferred property exceeds the aggregate fair market value. Section 337A says that a liquidating corporation recognizes no gain or loss on distribution of property to 80% owned subs. Section 337A provides that the liquidating corporation is going to recognize no gain or loss on the distribution of property to an 80% distributee, that should say distributee, in complete liquidation to which Section 332 applies. But do note that this provision only applies to the 80% owner. So if you have some minority shareholders in there, whoever owns the remaining 20%, the liquidation for their purposes is going to fall under the general 336A rules. So they are going to recognize gain, but they are not going to get to recognize loss. On the shareholder side, Section 332A is going to apply to the parent corporation that's receiving distributions in liquidation of a solvent subsidiary. So it's only going to apply if the subsidiary is solvent. If the subsidiary is insolvent, Section 165 and 166 are going to apply. We talked about those earlier in this section. It's going to allow the parent to recognize ordinary losses on its investments. And again, these rules don't apply to minority shareholders. They fall under the general rules. All right, now moving into just some special shareholder issues. If we have partial liquidation, so we're receiving payments, and in this year we receive one payment in a series of distribution payments. For tax purposes, I can treat those first distributions that I receive as a recovery of basis. And if you remember, a recovery of basis is not taxable. And what we're talking about is the basis in my shares. So as I'm receiving money, I can treat that receipt of money or property as a recovery of basis as long as I still have basis in those shares. But I cannot recognize loss until the final distribution is received. If it ends up that I have a required payment to make after liquidation, maybe it's usually something I didn't expect. Maybe I have to satisfy a contingent liability or something like that. For tax purposes, I get to treat that payment as if the corporation had made the payment. So however the corporation would have deducted that payment on its tax return is what I get to do on my tax return. It is not going to affect the tax treatment of the liquidation payment. And then if I receive installment obligations as a plan of liquidation, I usually value those at their fair market value just like any other asset. But if the corporation acquired that installment obligation during the 12-month period after the announced liquidation, but prior to the receipt of that, I can recognize gain on those installment obligations as the installment payments are received. So over a period of time as I am receiving those payments. On the corporate side, I can deduct the cost of liquidation on the final tax return. So I may have to pay accountants or attorneys to get this corporation liquidated. If I do, I can deduct those expenses on the final tax return. Capitalized expenditures that are unamortized at the time of liquidation can be deducted if they serve no further value to the corporation. So I can just deduct them. But if I have capitalized expenditures and they provide value, then I can allocate those to the shareholders. So something that provides value might be a prepaid rent, prepaid insurance on an asset that the shareholders take over. Those have value, so I can allocate those to the shareholders. If I'm a corporation that's liquidating and I have a net operating loss, we know I can carry those back and forward. So in the year of liquidation, I can try to carry it back. I obviously can't carry it forward because the corporation is ending. So if I can't use it up by carrying it back, I could choose to make an S election for the liquidation year to allow the net operating loss to pass through to the shareholders, and then maybe the shareholders could use it on their personal tax returns. If I am retiring debt, the general rule is a shareholder is going to recognize no gain or loss when the liquidating corporation pays off an unsecured obligation owed to the shareholder unless the payment differs from the adjusted basis of the debt. So this situation would arise when a shareholder makes a loan to the corporation and then the corporation pays off the loan. Just general tax principles would say that there's no gain recognized when we pay off a loan. Now, if we pay off a loan and the value of the payment received is more than the basis of the loan, then there would be a gain. The corporation also recognizes no gain or loss upon the payment of cash to satisfy a loan. If the corporation is going to distribute property to satisfy the loan, then the tax treatment is as if it is sold for fair market value. So we pretend like we sold the asset for fair market value, recognize gain or loss, and then distributed that asset to the shareholder in satisfaction of debt. Section 332A only applies to amounts received in liquidation. So if a parent is going to receive property in payment of the subsidiary's debt, the parent can recognize gain or loss to the extent the payment differs from the parent's basis in the debt. So if it's a liquidation situation, 332A is only going to apply to amounts received in liquidation, not amounts received as payment for a debt. So it's not going to change the tax treatment of amounts received in payment of a debt. Section 337B provides that a liquidating subsidiary, though, cannot recognize gain or loss when non-cash property is transferred to the parent to satisfy the debt. And this is not applicable to debts owed to other shareholders or third parties. And then when we are choosing to liquidate, we need to consider when to do that. We need to consider timing. And here are some important considerations. We first want to consider tax positions of the corporation and shareholders to ensure the best possible tax result. So you need to check, especially if it's a small, closely held corporation, you need to check the tax positions of course, the corporation, but also your shareholders to ensure that this liquidation isn't going to be a terrible tax result for them. So we want to look at the capital assets, see if we have any lost property in there, figure out how to manage that. We want to look at the lost property and the gained property. We might want to sell some lost property before the plan of liquidation. And then we might want to, if we have gain and lost property, we want to coordinate that so that we can have the capital losses offset any capital gains. We also want to see if we can create any ordinary loss on liquidation, right? We can do that through Section 1244, or if it is a corporation, a corporate shareholder, Section 165 and 166, if that corporation is insolvent, would allow ordinary loss. We might want to achieve an 80% ownership in one shareholder or corporation prior to the adoption of liquidation. We would do that if we didn't want to recognize gain or loss. But if we do want to recognize gain or loss, we might want to divest some ownership to fall below that 80% parent sub ownership rule prior to the adoption of the plan of liquidation. In problem 43, we have parent corporation who owns 100% of subsidiary corporation stock. The adjusted basis of its investment is $175,000. A plan of liquidation is adopted and subsidiary distributes to parent assets having a $400,000 fair market value and a $300,000 adjusted basis to subsidiary, and liabilities in the amount of $60,000. Subsidiary has a $150,000 earnings and profits balance. A, what are the amount and character of subsidiaries' recognized gain or loss on the distribution? We know under the general rule, if subsidiary is distributing assets worth $400,000 with a $300,000 adjusted basis, we know that we would have a $100,000 gain. But remember, we have different rules if we have a parent sub with an 80% or more ownership, which we have here. So we know there's no gain or loss. So in Part A, we'd have a $100,000 realized gain, but it wouldn't be recognized. 337 doesn't allow recognition. Part B, what are the amount and character of parents' recognized gain or loss on the surrender of the subsidiary stock? Again, we know under the normal rules, we would compare the parents' assets they're receiving with the parents' adjusted basis in the subsidiary stock. And here they also took over the liability. So they received an asset worth $400,000, but we would subtract the value of the liability. So they'd receive $320,000 worth of asset. We would compare that with its $175,000 adjusted basis, and we would have a gain. But again, that's a realized gain, but it's not recognized because of Section 332. C, what basis does the parent take in the assets? Since 332 and 337 are in play here, we take a transferred basis. So the assets, the subsidiary has a basis in the assets of $300,000, so it's going to be transferred to the parent, the $300,000 carryover basis. Part D, what happens to the parent's basis in the subsidiary stock and to subsidiaries' tax attributes? The only tax attributes that we have in this problem are the earnings and profits. Those are going to go to the parent. And then the basis in the stock is just going to disappear.